Hi there. Tencent is getting cheaper and cheaper. The stock price has declined by over 50% from its peak. It had a higher decline, around 70%, then the stock price rebounded, and then it went down again. That happened because the growth in revenue has decreased. The revenue grew by 3% quarter over quarter. Now, year over year, the revenue is up 11%. But the market is focusing on the short term. And that's why you see another decline in the stock price, about 20%. Moreover, Tencent also reported a decline in advertising. As you can see, online advertising is down 15% quarter over quarter. If you look at year over year growth rate, online advertising is up 17%. When the market sees a decline in the short term, they assume that will continue in the future, and that's why the stock price has reacted. It went down by over 20%. And now the market cap is about the same as the fair value of Tencent. Now, if you look at the whole picture, the revenue is up 11% year over year, and the profits 27%. Moreover, Tencent has almost 54 billion in cash. The CEO and founder of Tencent said they are investing in AI and cloud infrastructure to embrace new opportunities. Plus, they also did some buybacks. They've bought around 12 million shares. And if you look at the number of users, it's up 2% year over year. Quarter over quarter, it was stable. As China has 1.4 billion people, Tencent is a leader in the social media industry. Another problem that Tencent reported is a decline in their subscriptions, especially from long-form video subscriptions. They had a decrease of 9% year on year. That happened due to delayed content releases. But music subscription revenue grew 30% year on year. So they had some losses but also gains. As I said, most of the decline in the stock price came from a slower growth rate. The market expected a higher growth rate, but that didn't happen. And that's why the market reacted. But Tencent is still a stable business. They have about 1.3 billion users. Now let's see the valuation, where Tencent is expected to grow by 10% in the next 10 years. The fair value is around 240 billion, plus their investment portfolio of about 117 billion. The final fair value will be around 350 billion. And now the market cap is around 380 billion. So for a 10% annual return, the fair value is about the same as the market cap. This is the normal case, where a growth rate of around 10% is expected. Now let's see the risk. If Tencent grows only by 5% in the next 10 years, then the fair value would be around 114 billion. Plus their investment portfolio, the final fair value will be around 241 billion. This can happen if Tencent loses more market share, you see a decline in the number of users, the revenue goes down and also their profits, and the market cap can go to 200 billion. So you have to be aware of this risk. And the reward, if Tencent grows by 15% in the next 10 years, then the fair value would be around 440 billion. Plus their investment portfolio, the final fair value would be around 550 billion for a 10% annual return. So if Tencent delivers a higher growth rate in the future, about 15%, then the stock price is quite cheap at the current level, as the market cap is around 380 billion. This can happen if Tencent gets more opportunities, especially in AI and cloud infrastructure. Moreover, you also get a small dividend around 0.7%. Plus the management is also doing some buybacks, which will increase your value even more. So at the current price, Tencent seems fairly valued for a 10% annual return. But you also have to be aware of the risk. If Tencent faces more competition in the future, then your return may be lower. Now, there is another risk that many people don't like, which is China. If China does some stupid things, then your investment can go to zero. I don't think that will ever happen, but you never know, and that's why you have to be aware of that risk. So it's up to you if you like the return you get and the risk you have. And if you have any questions, please let me know in the comments.